Get your free copy of the complete tutorial at www.teachucomp.com/free.
In essence, liabilities are the opposite of an asset. They are the debts that the company has that must be paid. Most often, these debts are in the form of simple bills received that need to be paid. Specifically, the bills you currently need to pay are called your accounts payable. In this lesson, we will examine accounts payable and other types of liability accounts. Liabilities appear along with assets and equity in the financial report called the balance sheet. In the balance sheet, under the assets, you will find the liability and equity account balances. In the balance sheet, which we will discuss later, the total assets equals the total amount of liabilities and equity. And this is because all of our assets, from cash to equipment to inventory, are derived from funds shown in the liability and equity accounts. Liability accounts are displayed above the equity accounts in the balance sheet, and the liability account balances are displayed within the balance sheet in descending order of payment obligation. The most immediate debt due that needs to be paid within 1 year, known as current liabilities, are listed first. Then less immediate debt, such as the long-term liabilities, which need to be repaid in a period greater than a year, are listed. Liabilities are typically incurred when a vendor sends you a bill of some kind that you need to pay. Vendors could be inventory suppliers, utility companies, taxing authorities, or even the financial institutions from whom you've received loans that must be paid. These are often the everyday bills that need to be paid in order to keep the business running. The first liabilities shown in the balance sheet are the current liabilities. These obligations must be paid within 1 year. These liabilities can create havoc in a company if the company has inadequate cash to cover the payments. It is very important in business to keep your creditors and vendors pleased, as they provide various essential services for the company. An unhappy and dissatisfied set of creditors and vendors can threaten the survival of a company. The best way to keep them happy is to pay the bills on time, or early if possible. The current liabilities consist of the following accounts: accounts payable, accrued expenses payable, notes payable, and the current portion of long-term debt. One of the best ways to control the amounts that need to be paid out in your current liabilities is to only use these accounts to acquire short-term assets, like cash, in order to purchase things such as inventory. Following the current liabilities within the balance sheet are the long-term liabilities. A long-term liability is the portion of a long-term loan that is not due within the next 12 months. It is usually listed below the current liability section in the chart of accounts to show that the loan does not have to be fully paid in the coming year. Long-term debt provides cash that can be used to purchase fixed assets or provide permanent working capital. The artful use of this type of debt can enhance profits, but can also expose the company and its investors to greater risk. This is especially true in the event that the company is unable to fulfill its payment obligations. Next, we're going to discuss some of the common current liability types and the long-term liabilities that are shown in the balance sheet.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.